Good evening. Today, the United States takes decisive action to stabilize our economy and protect the
In
dollar.
1971, the United States government made a quiet decision that changed every wallet on Earth. No election, no public debate. A press conference on a Sunday night when most people were watching TV. And just like that, the money in your pocket became untethered from anything real. No gold, no silver, just trust. And here's the part nobody tells you. That move didn't just change economics. It rewired the psychology of every human being who uses money, which is all of us. This is the invisible architecture of wealth, the structure underneath everything, the part you were never meant to notice. Let's pull back the curtain. Here's a question worth sitting with. What is money? Not philosophically, practically. Right now in your bank account. What is that number really? It's not gold. It hasn't been since 1971, when Nixon ended the Bretton Woods Agreement and severed the dollar's link to physical metal. It's not a government promise to give you anything tangible. It's a number, agreed upon, collectively believed. Money, at its core, is a shared hallucination. And the moment you understand that, not as a conspiracy, but as a historical fact, you start seeing why some people accumulate it almost effortlessly, while others work hard their entire lives and still feel behind. It's not intelligence. It's not luck. It's whether or not you understand the architecture, the invisible rules that govern how money flows, how it's created, and why your brain is almost perfectly calibrated to make you bad at keeping it. In 2001, researchers at MIT ran a study. They auctioned the same item, tickets to a sold-out basketball game, to two groups. One group paid in cash. The other used a credit card. The credit card group consistently bid twice as much. Same item, same people, different pain. Behavioral economists call this the pain of pain. When you hand over physical cash, your brain's insula, the region associated with disgust and physical pain, activates. It hurts slightly to spend real money. Your brain perceives it as a loss. But swipe a card, tap your phone, the pain disappears. The transaction becomes abstract, and you spend more. Now ask yourself, who designed the financial systems you use every day? Banks didn't move away from cash out of convenience. They moved away from cash because abstract money is money that moves faster. Faster spending, faster borrowing, faster interest. This is not speculation. It's in the academic literature, and it's in their business models. The first layer of the invisible architecture isn't in a boardroom, it's inside your skull. And there's a second psychological force working against you. Economists call it present bias. Your brain is hardwired to overvalue what's in front of you right now and undervalue what's coming in the future. This is why a $5 coffee today feels worth it. And a $50,000 retirement gap at 65 feels abstract and distant. Same reason lottery tickets outsell index funds, even though the math isn't close. Your brain was built for a world without compound interest. It was not built for the modern financial system. Here's something most people learn, and then immediately forget, because it seems too strange to be true. Most money isn't printed, it's typed. When a bank approves your mortgage, it doesn't go into a vault and count out your loan and physical bills. It opens a ledger and types a number. That number, your debt, becomes new money in the system. This is called fractional reserve banking, and it means commercial banks are legally permitted to create money from credit. The Federal Reserve, America's central bank, can influence how much of this happens by adjusting interest rates, low rates. Banks lend more money enters the system, prices tend to rise. High rates, borrowing slows, the money supply tightens, economic activity cools. This is how inflation actually moves through an economy. Not like a wave hitting a beach all at once. It trickles, first into financial assets, then into housing, then into consumer goods. By the time you feel inflation in your grocery bill, wealthy investors who hold assets have already been protected because their net worth rose with the tide. This is not a conspiracy. It's just physics applied to finance. Money flows downhill, and the architecture is built on a slope. The economist Hyman Minsky spent decades studying this pattern. His conclusion: financial stability itself breeds instability. Long periods of calm encourage risk-taking. That risk-taking creates fragility and eventually a crisis. His colleagues dismissed him for years. Then 2008 happened. They called it a Minsky moment. In 1900, John D. Rockefeller was the richest man in America, adjusted for today's dollars, worth roughly $400 billion, more than Elon Musk at his peak. People assumed it was the oil. It wasn't just the oil. Rockefeller famously said the greatest mathematical discovery in human history was compound interest. He used it, reinvesting dividends, acquiring assets that generated more assets, to create a self-perpetuating financial engine. Here's the brutal truth about compounding. It requires time and a base. The larger your base, the faster the growth. This is why wealth, left alone, tends to concentrate. Not because the wealthy work harder, because the mathematics of compounding are ruthlessly indifferent. $1 invested at 8% annual return doubles every 9 years. $2 do the same. So does 2 million. But you need the first dollar, and the patience, and the financial literacy not to panic sell when markets drop 30%. That financial literacy, historically, it has been distributed as unevenly as the wealth itself. The wealthy hired advisors, built family offices, passed knowledge across generations. Everyone else got a brief lecture in high school about balancing a checkbook. That gap, the knowledge gap, is as real as the wealth gap. And it widens quietly year after year, invisible to anyone who isn't looking for it. So what do you actually do with any of this? 3 things. First, make pain visible again. Track your spending in cash equivalent terms. Not just card swipes, actual numbers reviewed weekly. The research is clear. People who manually review spending reduce it by 15 to 20% without trying to. Awareness is the mechanism. Second, understand where you sit in the flow. Inflation hits asset holders last. That doesn't mean you need to be rich to own assets. Index funds, real estate, even I-bonds. These are instruments that move with the monetary system instead of against it. The goal isn't to beat the system. It's to stop standing directly in its current. Third, take the long view, even when it's uncomfortable. Compound interest rewards patience more than intelligence. A middle-income earner who invests consistently for 35 years will, in most historical scenarios, accumulate more wealth than a high-income earner who starts late and invests inconsistently. Time is the one variable that money cannot buy back. The invisible architecture isn't designed against you. It's mostly just indifferent to you. And indifference can be navigated once you can see the structure clearly. Here's the mystery solved as much as it can be. Money is not math. It is not neutral. It is a human system built by humans with interests, layered with psychological quirks, and governed by rules most people never read. Understanding those rules won't make you rich overnight. Nothing honest will promise you that, but it will make you harder to fool. And in a world built on financial illusions, that is genuinely worth something. If this kind of truth is what you came here for, subscribe to Mystery of Money. No schemes, no hype, just the real mechanics every week. We're building something here for people who want to understand, not just consume. We'll see you in the next one.